Are you interested in a deep dive into Allstate insurance? Allstate is my number 4 position in my portfolio, and I realized that I made a bit of a mistake and I need to correct that. So if you are interested in hearing about that, stay tuned. Hey everybody, Kevin Burgess back again with the series where I look at the investments in my portfolio starting from the highest to the lowest, and this is number 4 in the series. Number 4 holding for me is Allstate Insurance. I have a process that I go through where I go through 8 steps and look at these companies, and one of the mistakes I made is I shortcutted that process with Allstate. So I've noticed that. I did this analysis, it came out, and I want to share with you what that mistake was and now what I'm going to do to correct it. If you like the content of this video, consider giving it a thumbs up. It helps the channel and I would really appreciate it. It means the world to me. If you like to learn about dividend investing and want to hear more videos from me, consider subscribing to the channel and ringing the bell, and you'll get notifications of future videos. Without further ado, let's get started. Okay, let's dig right into the analysis on Allstate. Allstate was founded in 1931 and is based in Northbrook, Illinois. Allstate provides property and casualty and other insurance products in the United States and Canada. With a market cap of $36.1 billion, they are part of the crowded property and casualty insurance industry. This industry of property and casualty insurance is a crowded space, so it's an industry that transfers risk from the policyholder to the insurance company. The insurance company then manages that risk and hopefully has it not occur, so that they can keep the premiums that they've collected for transferring that risk. In terms of competition, the competition is fierce in the casualty and insurance industry. So for example, you have MetLife, you have Prudential, you have Allstate, Progressive, State Farm, Aflac. So the list goes on and on. There's just a tremendous amount of competition in this space. In terms of segments, there are 4 for Allstate. The first one is Allstate Protection. It offers private passenger, auto, and homeowners insurance. That's probably what we think of most when we think of these types of insurance companies. They have some specialty auto products like motorcycle, trailer, et cetera. This is probably the main segment that we think of when we think of Allstate. They have Protection Services segment. It provides consumer product protection plans. And, you might recall this one being these car warranty things. So they will find you regardless of wherever you are. There are some cute commercials about that and some memes that have come out. And I'm displaying those on the screen at the moment. And so this Protection Services segment does some other things, but it also has those kinds of things in it. The third segment is their life insurance. They offer traditional life insurance products, and that's another thing you think of when you think of Allstate. And then Allstate Benefits. They provide life, accident, critical illness, short-term disability, and other health insurance products that can be used by companies or individuals. So those are the 4 segments. In terms of competitive advantages, since insurance is a commodity, there are very few competitive advantages. There's possibly a small competitive advantage here for Allstate in that they have a captive agent insurance model, and they also issue bundling. So there's a bit of a competitive advantage there. In terms of acquisitions, they have acquired in the last few years Safe Auto and National General. These 2 actually use an independent agent channel, which really doesn't fit into their competitive advantage. So the question I have is that even a strategic fit for Allstate? In terms of risks, they have the risk that their claims exceed the reserves that they've set up and even the premiums that they've collected. Also, they have the risk of impairment of their investment assets. So if you think about it, the way an insurance company makes money is they sell policies. So they charge premiums for policies. They incur costs on those policies, and the net of that is their earnings. The other way they make money is they're sitting on a lot of cash because premiums were paid prior to any claims that are received. So this cash then gets invested. So they make investment income and they make policy premium income. Those are really the two main ways that insurance companies make money, and they have the risks related to both of those. Let's move into their capital allocation. They've grown their dividend pretty consistently since the financial crisis of 2009. And you'll notice that in the last 5 years, they've grown their dividend by 12%. And in February of 21, gave a 50% increase in their dividend. That's really phenomenal. And over the last 20 years, you can see that they've grown by 6%. Their dividend yield is currently around 2.57%, which is a little bit on the low side, but with that kind of growth, maybe it's worthwhile. Shares outstanding, they've done a really nice job of buying back shares. You can see all of the share buyback information on the right-hand side of this slide. They have authorized a new $5 billion common share repurchase program. They've accelerated share repurchase programs that were issued in September. And during the first 9 months of 2021, Allstate repurchased 18.8 million common shares, or 6.2% of the total common shares outstanding. That's a lot. They've bought back a lot of shares in 2021. Financial metrics, their sales are up and to the right. That's kind of what we look for. In terms of the earnings payout ratio, that looks really good. They're sitting at last 12 months at 18%. You got this 50% dividend increase, which drove the earnings payout ratio up to about a 33%. And also in terms of cash flow, very well covered. So this gives them the ability to raise dividends more in the future also. In terms of earnings per share, you can see that their earnings per share has been growing. The next 12 months looks a little bit dim, though. It's dropped in by about probably 40%. Their free cash flow, however, is up and to the right, and that's what we look for. Most likely, the earnings per share has been impacted by claims and reserves that were set up. So they've needed to set up additional reserves for the claims, for the policies that they've already issued. In terms of dividend safety, Simply Safe Dividends rates them as an 80, and their S&P credit rating is an A-. So those are good metrics. The net debt to capital is a little bit on the high side. Not a whole lot, but a little bit. Oh, their interest coverage ratio is phenomenal. It's at a 26, so they have no issues covering that debt. According to Morningstar, the valuation for Allstate is around $120 per share. It last closed at 125.95 per share. So in other words, current price is around 126. Its valuation is 120. So it's really at a premium of about 5%. The average analyst price target, according to Seeking Alpha, is around 130. So there's even predicted not to be a lot of room to move here on this stock. They've had a 12% dividend CAGR and a 2.57% yield. So these are all, decent metrics, but they're not a screaming buy at this point. So in summary, the insurance industry has struggled during the pandemic. They're a highly competitive industry. Insurance is a commodity with no strategic competitive advantages, meaning that there is no real long-term moat here. In terms of positives, there's a significant share buyback program, and they have really been knocking it out of the park there. Their debt payments are easily covered. They have a 12% annual dividend growth with 50% coming in 2021, and their payout ratios are low and they have room to grow. The thing I want to point out here, and I believe the mistake that I made when I first entered into this investment with Allstate, is missing the fact that insurance is a commodity and that there's no moat. One of the things that I look for as a dividend investor are companies who have at least a narrow moat, but we prefer those that have a wide moat. And insurance companies just do not have that. And so I missed this. And I shortcutted the process, and I did not walk through the entire analysis process and missed this. This investment became the fourth largest investment in my portfolio, and there's no moat. So, I want to share with you not only the things I do well, but also the things I don't do well. And I believe this is one of those things I did not do well. So what does that mean? What am I going to do? Well, I plan to sell off the Allstate position, which is the number 4 position in my portfolio, and invest in businesses that have larger moats. So I hope that's been helpful. This is a great company. They got some great financial metrics. It's why I invested in them in the first place. But the moat, the strategic competitive advantage for Allstate is just too narrow. There's not enough strategic competitive advantage there for me to believe in them for the long term. And so therefore I've decided to exit this position. As you heard in the last video, I left some of my equipment at home. We're at the beach this week. I've ordered some new equipment to hold my phone. You'll notice it's a little bit on the shaky side. So that should be here tomorrow. So hopefully this is the last shaky video you will see. But I thought it was important to work through this Allstate and get this video out because I wanted to make sure that you guys saw this. I ended up selling all 333.268 shares of Allstate yesterday morning. And you know the drill. I'm not an investing professional. I'm just taking you along for the ride as I work through this portfolio. And I want you on this journey with me for a couple of reasons. Number one, it helps me be accountable to the process. If I'm going to do a video on it, I need to make sure that I know what I'm doing and that I've not taken any shortcuts like I did originally here with Allstate. Secondly, I want you to come along this journey with me to inspire you to build a passive income portfolio so that you can achieve personal freedom, be able to do whatever you want, when you want, which is really the goal of wealth building. There are other analysis videos I've done in this series. I will link them at the end. I'll also give you a glimpse at my new top 10 portfolio at the end as well. And with that, I look forward to seeing you on the next video.